Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Back on the line with us today is David Skarica, based out of the Bahamas. He's the publisher of addictedtoprofits.net. David, welcome back to the program.
Thanks for having me, Colin.
I got an email from you last week, and a big component of your portfolio, as discussed on our show, is not only finding great gold stocks to invest in, but also balancing things out by being short and buying put options on companies that you think are overvalued or flawed. And one of those companies that you were short on had an astounding drop last week, I think 65%. And most worrisome about that was the business of that company, its Home Capital Group, which provides loans for houses in Canada. David, I want to get your thoughts on why that stock collapsed and what it means.
Well, first of all, I think my whole premise at first was I think that the Canadian housing market is a bubble. I'm from the Toronto area originally, and I go back every year, and I actually keep like the page of, the real estate prices every year when I go back in the area I'm from, because you can slowly see how they just like are popping up like 20-30% every year going back the last 3 or 4 years, and it's complete insanity. And there was a similar bubble in Toronto in the late 80s, and then that all blew up, and and actually Toronto home prices adjusted for inflation did not go above that late 80s top until 2009. So I've seen this happen there before, and I think it's even worse now because now it's all over the whole country, especially Vancouver and Toronto, not just confined to one city. So what I was looking for was a company to kind of play it. And look, at the Canadian banks, they're probably going to have some problems, but for the most part, they've been very well run. There isn't the capitalization, or so I should say the leverage in the Canadian housing sector in terms of, when they bundled those mortgages and sold them off. So I was looking for these smaller subprime lenders, and one was Home Capital Group. And when I was reading this article about it, there's a short seller named Mark Cohodes, and he ran a short fund and made a lot of money in the dot-com bust. And he looks for these fraudulent companies, and he had noted that Home Capital Group was lying in terms of they weren't doing income verification of a lot of people applying for mortgages, and just were issuing a lot of shady mortgages to people who probably weren't qualified. And so they had their own internal problems. Plus, you have the macro thing if the housing bubble goes down. And this stock basically blew up last week. There'd been a run on the bank for about the past month. And, and part of the reason probably was a lot of these bad mortgages that they had issued and the whatnot. And the problem is the way that a subprime company like this attracts capital is they pay out higher interest on deposits or on bonds than, say, a bank does. So that's how they attract capital. Then they use that capital to, do the loans. So when they had a run in the bank and they had $2 billion in their, coffers as of the end of March, and now they only have $300 million. So they've had a run on the bank, and that means that they can't really issue any more mortgages. And also, they have their own bonds that they've issued themselves to raise capital. They probably can't even meet the interest payments on these bonds. So this is a complete disaster. The company's probably going to go under it. And I think this is really, really key for the Canadian housing market because it's like a domino effect where what's happened is because you get this loose credit in a housing bubble, Home Capital Group, which is mostly like subprime mortgages and people who can't get mortgages in one of the big banks in Canada, what happens is they give you your mortgage. So all of a sudden the $200,000 homes that say go to $400,000, Home Capital is giving the mortgage to those people. Well, the people who sell those homes for $400,000 are then buying the $800,000 homes, and the people that used to be $400,000, and then the people that are selling those are taking that $800,000 and then buying the $1.5 million home. So it all is like this trickle effect. And now that the borrowing and the lending on that kind of lower tier is going to dry up, I think it will slowly spread through the rest of the Canadian housing and mortgage market. And at the same time, Vancouver and Toronto, so BC and Ontario, have passed 15% taxes on foreign buyers purchasing homes to slow down, the housing prices. So it's like the perfect storm where you've got this subprime borrowing blowing up and you've got this probably slowdown in foreign investment at the same time. And I think personally that I've been calling this for a while, and oil's at 48 today. Oil's going to roll over again into the second half of the year. And, of course, oil in the Midwestern part of Canada is a big part of the economy. So I think you got this perfect storm for maybe this Canadian housing market to finally start to roll over. So what I've done is I've prepared a report, which I'll have released probably on Tuesday, where I've outlined 5 or 6 other shorts. 2 of them are like other kind of smaller subprime lenders. One of them is, like a smaller Canadian bank. And then the other couple are a couple of the Canadian banks, but the banks that I think are the most exposed. One Canadian bank actually could have problems. So that's what I've done. So I've got this little short portfolio. And just to finish off here, see what happened in the United States housing bubble. This is why I think Home Capital Group is such a big deal, is that one of the largest subprime lenders, it was a company called New Century. They went under in about March, April of 2007. So the stock market didn't even top till a few months after that. And the financial crisis didn't begin for well over a year at that. But that was kind of like the alarm bell when this huge mortgage lender, New Century, went under, that things were going to start to spiral downwards. And I think Home Capital Group is kind of the same way.
Okay, well, by the time this interview gets released, then it sounds like your paper will be out on these other opportunities. I'm sure people can find that at addictedtoprofits.net. One further question here. Why do you not think that this is just a bad apple situation? I mean, Home Capital Group is probably a pretty small percentage of the entire Canadian loan market, and maybe they were just picking the riskiest ones. Or has your due diligence told you otherwise, that other banks or groups lending are providing similarly risky and bad mortgages as well?
Well, the other subprime one I'm going to short. It's actually, I'm happy because I haven't entered the position because it really gapped down too last week. I'm not going to name it. I'm going to leave that for my subscribers. But it gapped down last week, and it just reported earnings May the 1st today as we're doing. So the earnings were good because, of course, it reported in a quarter when housing was still very strong. But they're kind of doing the same thing the Home Capital Group did. Actually, a lot of the people who worked for Home Capital Group moved over to this other company and they're doing the same kind of thing there. So doing kind of background checks on loans and very loose standards. And see, what these companies do is they just issue loans, and that's how it looks like their top line and their revenues and their profits are growing. But of course, to do that, they have to issue all these loans to people that really aren't probably qualified to get them. So I think this one would be the next shoe to drop. And look, common sense dictates this, right? If, these two subprimers are probably the worst, and the Canadian banks obviously aren't doing as, all these shenanigans, but credit always gets too loose in a housing bubble. And there's probably people, even through the banks, that have gotten loans who shouldn't have got them. So it just makes sense that in this huge bubble, everyone gets carried away. And the biggest problem is, if the house drops 20%, all these people are going to have negative equity in their houses. And, that means you kind of end the boom because all of a sudden people can't flip. They can't take money out of their house to just spend it on renovations or vacations. So I just think that becomes kind of a spiral. And so I think these two are kind of the bad apples, but you're definitely going to have some problems at the major banks because everything filters over. One of the problems I see, to be very honest, is most people I know in Canada have a mortgage, not as a traditional mortgage, but through a line of credit, right? So I've never really seen that until the last few years. And probably what's happened is a lot of people who probably shouldn't have a line of credit, they should have a proper mortgage at a higher rate because they're a little higher risk. They probably have a line of credit, and then they're going to be in trouble when their house price goes down.
Yeah, good point. Good point. For Americans, that's an unusual thing, but Canadians actually oftentimes do take line of credits out that don't have fixed rates on them to pay for their house, so that could be a bit of a catastrophe in the making. David, I want to switch over, now that we're about halfway through our time here, to what's happening with the GDXJ. We've had some talk of this on Palisade Radio. Rick Rule discussed this a bit, but we haven't really gone into detail. Essentially, the GDXJ is rebalancing because it's gotten too big. It's no longer going to be a representation of juniors, maybe more so mid-tiers now. And a lot of companies that were in the GDXJ are getting pushed out, meaning there's been a lot of selling, and that's put downward pressure. So can you talk a little bit about what you think that that's going to mean for the sector?
Well, first of all, I think it's a great opportunity for two reasons. Number one, if you're interested in those stocks that have kind of a $500,000 to $4 billion market cap, there's going to be a great buying opportunity in them because the GDXJ, I think they're upping their bottom tier now to $3 billion, up from $600 million. So anything that's got that $1-2 billion market cap is going to be sold. So, that would be like a company, and just, I have no position in it, but, I'm watching it. Say a company like B2 Gold, right? Like a small producer like that. Like those are going to be the opportunities because the GDXJ just has to sell them. But this rebalancing is going to be done by the middle of June. So I think you can, maybe start accumulating shares in some of those kind of smaller producers as the GDXJ dumps them and has to put pressure on them till then. And a second thing I think that's great is that, problem I have with these ETFs is I really feel that it promotes people being lazy and they don't want to think anymore and they don't want to do their own research. And I think if you do your own research in the gold and silver sector, guys like me and you, we want to buy these smaller producers or near production, or small producers that have a chance to expand production, or companies that are in the early stages of building a resource. And I just think now people have to now look at these companies rather than just like blindly say I'm buying the GDXJ. So I think you can now find opportunities in these companies, and also it will create more buying in these companies because now that someone who's interested in gold juniors can't buy the GDXJ, they're going to have to look at individual companies. And I think that means you get more money flowing into the junior mining sector because, like I said, like if someone just says, "Oh, I'm selling the GDXJ now because I want an exposure to those smaller miners," they'll buy those smaller miners, or maybe even more open to buying junior mining stocks. And for example, Colin has gotten me into a couple private placements in the last year, and I won't the two companies. Actually, I will name them. And just so you know, the disclosure is my family. We own both of these. One is Wallbridge, which we mentioned the last time around, which actually had some great drilling results recently. And the other one is Carib Copper. And these stocks from the placements are up about 30 and 40%. So that's the perfect example when you actually do your research and you find a couple companies that are well run, and you're in these smaller market cap companies, so it doesn't take as much buying to push them higher in price, and they can do well. And they're doing well at a time when the GDXJ is kind of falling apart. And the last thing I'll say in this too is the GDXJ is a real warning for the market because there's been this bubble in the last 6 months or so of people just piling into ETFs, people just thinking that the NASDAQ or the S&P are the way to go. They call it passive investing. There's no point of owning an actively managed mutual fund or a hedge fund. No point of listening to someone like you or I. Just go buy these ETFs or go buy the FANG stocks or whatever, and they'll always go up. And you see with the GDXJ, when the ETF gets too big and then has to pile out, it puts selling on everything. And what's going to happen in the market is these ETFs have become so huge. There's nearly 2.7 trillion in them now. When you get that kind of capitulation and that panic selling going on, everyone's going to be forced out, not just selling individual stocks, but selling these ETFs, which all own the same stocks. So I think that's also the warning of the GDXJ for the rest of the market. And just to finish off here, if you're interested in the two things that we've talked about here today, I'm doing a special offer. I usually charge a newsletter on a quarterly or yearly basis, but I'm going to offer a 2-month subscription for $140, and I'll have this huge report on Canadian housing, on these stocks that are potential shorts, And I've already put out a report on another company that's a corporate subscriber of mine, and that I own, and I think Colin owns, Mexican Gold Corporation, which used to be Source Exploration. And then, so I've done a report on that. I'm going to have a couple more reports on a couple more juniors in the next couple months. So it's a combination of the two. It's just kind of what you talked about with my newsletter, the shorting and the opportunities, I think, in the Canadian housing sector, and then the opportunities in some of these gold juniors as well.
Yeah, David, you mentioned Carube Copper, Wallbridge, and then Mexican Gold. Those are all three companies that are up in the last few months, despite the fact that if you held something like GDXJ or even one of the mid-tier companies, you'd probably be down pretty significantly, which brings me to a last point of discussion I want to talk to you about. What do you think the outlook is for gold and gold stocks? Gold was trading up near 1,300 for a couple weeks, and it felt like it might break through, and now the economy in the U.S. has just kept going up, and it seems that gold is bearing the brunt of that movement. When do you think things are going to reverse?
Well, if you look at the seasonal pattern in gold, and I do believe a lot in seasonal trading, this is probably the worst time of year, to be very blunt. The May-June area time frame is gold almost always pulls back in that time frame. Like if you go, for example, look when gold stocks busted in 2013, they were very weak. So what I could see, and I think I can kind of see the setup happening here, is I think the market's going to be weak over the second half of the year. The Fed will probably raise rates again in June, and you've got that GDXJ kind of finishing that rebalance. So I see an opportunity here probably in the next 2 months by the end of June, where that's usually the end of the worst part of the seasonal selling, and then you probably have the Fed do that last rate hike. And if the market begins to roll over, it could be the last rate hike, and then I think gold can start catching a bid really over the second half of the year. And I think one thing that's good right now on, because, gold is a way of playing, adversity or people being fearful or the whatnot, is that now with the French election looking like the moderate guy is going to win, the geopolitical world has really, really toned down now. And everyone's kind of complacent. They think all the populism and all that stuff is over. And that actually might put investors into a false sense of complacency in the next 2 to 3 months and set us up for a nice correction in the second half of the year. And another thing that's telling me this, and this factors to gold, because gold can trade counter to the stock market, is the market's becoming increasingly thin. It's those FANG stocks. I think something like 0.2% of the NASDAQ has accounted for like 50% of the gains. And that kind of tends to happen near the end of these rallies. But I would definitely look at that seasonal time frame by the end of June as being an excellent time, especially in these small junior stocks we're talking about, or in these kind of smaller producers that the GDXJ is going to have to drop or dump.
Right on. David, thank you for coming back on the program. Hopefully I get to come to the Bahamas soon and pay you another visit. Always a good time. But for now, we'll keep recording these interviews over Skype. Once again, David's the publisher of addictedtoprofits.net. I suggest you go to the site and get on David's free list and maybe consider paying for some expert advice.
Yeah, thank you very much.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?